Ladies and gentlemen, fellow patriots and freedom-loving Americans, welcome to The Source. Rule breakers, lawmakers, and influencers. In a world where the status quo works overtime to silence the truth, our guests are on the front lines, breaking rules, challenging narratives, changing laws, and shaping the future to serve the American people. This show is about the innovators, the disruptors, and the guardians who refuse to back down. Each episode, we dive deep with maverick entrepreneurs shattering barriers and building empires the American way. Bold opinion leaders challenging the narrative and igniting real change. Fearless lawmakers from local heroes to state champions and federal warriors, fighting to protect our liberties and put America back on top. This is The Source, where rules are broken for the greater good, laws are made to serve the people, and influence drives us forward. Today, I'm joined by Julio Gonzalez, CEO of Engineered Tax Services, also known as the Alpha Lawman on Instagram, right? That's your Instagram handle.
True, yeah.
Julio and I have done a couple episodes together. We did The Big Beautiful Bill, one of our first episodes together, and discussion about your influence in helping to drive that legislation.
Yeah.
And then we also did an episode about your latest book, Why Billionaires Love the Tax Code.
Yeah.
And so today we're going to talk about, here we are, we're in 2026. A lot of the key components of the Big Beautiful Bill are getting underway. Americans are going to start feeling the effects of the Big Beautiful Bill. If we look at it first from the level of the entrepreneur or the real estate investor, which we've talked about in our previous episodes, we're back to the 100% bonus depreciation deduction, right?
That's
in year
big.
one. And so, we went through this period of time where Airbnbs were suffering, right? And,
Sure.
Not only because of travel and other issues, but mainly because if you were buying an Airbnb as an investment, your tax deductibility of that property to help stabilize the income of it was diminished because of the sliding scale downward of bonus depreciation.
That's right.
So let's talk a little bit about the acceleration of bonus depreciation in year one, the 100% deductibility of that depreciation in year one, and how that impacts the small, everyday, Main Street investor who may buy a second home to the Airbnb entrepreneur who is buying real estate to monetize.
Well, it's the biggest thing we got done in that bill, honestly, because if you're a business owner and you're investing in your business, well, anything you buy for your business, you should be able to 100% expense immediately, right? You're making that investment, you're taking that risk. But we had it on a sliding scale where businesses were down to only being able to take 20% of an investment and write it off in the first year, and then 20% for the next 4 years after that, right? So they're only getting the benefit of that write-off over 5 years. They made the investment in the first year. We have to match that up, right? Because why are you going to put out the cash and invest in your businesses or investments and have to take all that risk and then have to expense it over a period of time? It makes no sense. We have to match those things.
And it's interesting the timing of the bill, because if you look at the environment that we were in to the environment over the past 4 years during the sunset period, interest rates have risen significantly, which means your carrying cost for that property has also risen significantly.
Yeah, I mean, look, it was a disaster. Interest rates, regulation, everything was against the small business owner. The tax code had basically eroded from 2017. And to get that restored and get that bonus depreciation, make the tax code permanent so it's not changing every January 1st for these business owners. They don't have to wake up to a new tax code, nor do the accounting firms that help our small business owners, right? So that's significant, right? That's getting rid of some of this regulation that was in there. Oh my gosh, what a great year for the small business owner. Well, they got a chance.
Yeah, so if you're looking at it from the perspective of somebody who's buying a second home, or someone who is buying maybe a second property to use as an Airbnb or some sort of property that they want to monetize, right? Just walk us through it. I buy the property, and then what happens?
Yeah, you buy the property, And then what happens
Whether
is,
I buy it cash or finance is immaterial to the tax treatment, correct?
that's right.
Okay.
That's right. That's great though, because you can leverage the write-off in a way. Well, let me give you an example. Okay. Well, so in 2001, my tax bill was around $1 million, right? And I just started the company in 2001. And what did I do? So I went and invested in real estate because we're rewarded. The tax code says if you go and invest in real estate, we're going to reward you. And back then we had bonus depreciation. So 2001, go buy a $5 million building. I use $1 million down. So I took that tax liability and put it into an appreciating asset, which the government rewarded us for through that tax policy. And they still do today. We think real estate's an important investment in our country. So now I had $1 million down, $4 million from the bank, $5 million property. We did the cost segregation study. What's that? Cost segregation study is an engineering study that says, well, it's not a building, it's not an apartment complex, it's floors, it's windows, it's HVAC systems, it's landscape. It's a lot of different things. It's 50 components that when we break those down, anything that's non-structural in that engineering report can then be expensed immediately under 100% bonus depreciation. So just to do this math, all right, I took $1 million tax liability, put it into a $5 million building, and then through the cost segregation study, determined I had a $2.5 million write-off, right? Significant, right? Immediate write-off. So the $2.5 million eliminated the $1 million of taxes, right? So now...
And you have a carry forward for that other $1.5 million, correct?
That's right, right? So it carries forward if I can't use it all. And ultimately, now have an asset that pays me dividends monthly, right? In rent, right? So the rent covers the
Debt
note,
service.
right?
Yep.
The debt service from the bank, and it provides a little bit of profit. And in this area, Palm Beach, where we're having this interview, most buildings double in value every 7 years. So you can think of it. If you hold that building, $5 million, then it's $10 million, then it's $20 million in 14 years. That's significant, right? But it's all because that $1 million in tax liability, we just put it into a building,
Right.
use the tax code, and then now it's a $20 million building 14 years later, right? So that's
But it's an important distinction for people to understand that this is investment real estate. This is not your primary residence, and that's one of the like I'm a big fan of Robert Kiyosaki in terms of his philosophy of own enough real estate to give you the income to live anywhere you want, right? A primary residence is not really an investment, right? You're limited on your tax deductibility.
That's right.
Right. You can't write off if it needs a new roof or it needs a new HVAC system like you could in investment property, right? Because investment property is not your primary residence and it operates like a business.
That's right.
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 So
it's every property except your primary residence.
yeah. And so there is an argument to be made, like I've always followed of, I'd rather have investment property and rent a really nice place because then I get all the tax benefits of the investment property, right? And I have a fixed cost of where I'm living.
Yeah.
Right?
Yeah.
When I used to own a primary residence, I needed a new roof. That was $60,000. I did the kitchen. That was $60,000. I did storm shutters. That was $14,000. I did hardwood floors. That was $15,000. Right? And those are all just out-of-pocket expenses that I have no tax advantage for doing. But if that was an investment property and I had tenants in there, my $40,000 roof is an investment in the asset and an expense to the company, right? So I get to write off the cost of that.
That's right. So, like Grant Cardone says that all the time. He doesn't live, he rents, right? But all his money in real estate is in investment properties, but not in a primary resident because he's going to rent that, right? So they had the same philosophy, and I think that radiates pretty well. Now, I'll say this, though. On a primary residence, you do have some tax benefits, right? I mean, you get property tax, so that's a negative benefit. But when you sell the property, there's some exclusions on the gains. And so there's a benefit there. You can 1031 into another property. So there's
on a primary residence, you can 1031?
Well, maybe, but you convert it to an investment
Take the gain
property.
and convert it into an investment.
That's right. So
what are the tax advantages at sale for having a primary residence?
Yeah. So we have an exclusion on gains for primary residence. So that's a big thing. Like you said, you can also do some other things through 1031s where you're converting that property at the end to maybe a rental property. I think that's a good strategy to look at, right? Because then you can take
And you have to have the property for how many years before that investment exclusion kicks in? Is it
for the
2 years or
2 years, and then there's some full exclusion benefits after 5 years as well.
after 5?
Yeah. So all that's good, right? So, but I think your philosophy is right, Grant. Robert, agree with you. And
So going back to the cost segregation, just to understand the logic of it, the reason why you had said, you're not just a building, your windows, your doors, your HVAC, your et cetera, right? Well, once all of those are put into service, they're theoretically, they have no value, right? So depreciate them over, 29 years previously for property?
39 years.
39 years, right? Well, I always understood the cost segregation in this, right? Once the electric's in the wall, I can't tear those wires out and use them somewhere else. I can't tear them out and sell them to somebody else. So technically, its useful life as an asset or a component of the asset is 0, right?
That's true, yeah.
Even though it will have a useful life for the functioning of the property.
That's true.
So that's why the engineering study is important and required, right? Because you have to break out all of those components, what their value was in the property,
Yeah.
and then that helps you to set the depreciation schedule.
Yeah, and I want to bring up another benefit of the cost segregation. So now we're going to break these components out. They're non-structural. We're going to write them off immediately under bonus depreciation being at 100%. But now you're right. These things have 0 value after a period of time. But if you don't have a cost segregation study, those components are not broken out. So you sell the property and they still have value in the sense that the government doesn't know that maybe certain components of that building or real estate are exhausted, right? So then with the cost segregation study, we know that we have broken out all these components, 50 components, right? And we can say now it's exhausted, so it has no value when I sell the property, so thus I can't have recapture on that asset.
Oh,
I think that's big, right?
Interesting.
And if we take it out, we can still, write off that value, but have no recapture because we have no benefit.
So is there a period of time that an investor would have to hold a property if they were not going to 1031 it that would basically sunset that recapture risk?
No. I mean, literally, like as things become exhausted and they really have no value to the building, then we can, but that's a good question, right? Because we have, in a tax world, we have engineering rules, right? So we say, okay, well, the life of electrical is 5 to 8 years, right? So we know after that 8 years, it's exhausted. Now, we don't know how long it's been in the building. We can do that through the study. But yeah, so that's great, right? We can eliminate a lot of the recapture. I don't think people understand that when they do a study. They just put the study on the shelves and do the accelerated write-up. But why not we use it to go through the components, identify which ones have no more value so that we put that into the sales contract and say, hey, we don't have recapture on those assets.
Interesting. So talk for a moment about 1031 exchange versus sell. Right? I recently learned, because I trade stocks and options, and I recently learned that it's not binary in the sense of I don't only have 2 choices when a stock goes up or down, right? I don't have to sell that stock to make money on that stock. And when the stock is going down, I don't have to sell that stock and take a loss to get out of it, right? I can use put options, I can use call options and different strategies to continue to monetize a stock if it's going against me, or to lock in a profit of a stock at an all-time high so that when it does dip down, right, then at least I have a monetization of that without triggering a capital gain by selling the whole asset.
That's true.
Right?
Yeah.
So when it comes to real estate, it's not binary also, in the sense that you could take an appreciated asset, and if you want to go into a different asset, you have more than one choice in the sense of, I don't have to your point about the building. I bought the building 7 years ago for $7 million. It's now worth $14 million, right?
Yeah.
I love the building. I want to monetize the asset. Okay, I can take loans against it, right?
Sure.
I can
you can do
remortgage
that.
the property, and I can, similar to what homeowners do with HELOCs,
Sure.
right? I can do that with an investment property. Or if I want to take that asset and trade up into a bigger asset, I can use a 1031 exchange to sell that asset and then reinvest that money into a new asset without triggering a capital gain and a taxable event for myself, correct?
Correct.
Okay, so take us through tax-wise what is happening in a 1031 exchange.
Yeah. Okay. Well, can I take you through a little bit of tax history?
Sure.
Like, I know tax is not sexy, but I want to give you a little perspective, right? Because I started accounting in 1980. 1031 was a tax rule where you could sell something and take those profits and not pay taxes on it or any of the gains associated with that asset and put it into a like kind asset. Right?
Okay.
So we could do that. Now, in 1980 through 2016, you could do that with anything.
Oh, really? So gold, silver.
Gold, silver, horses,
Oh, interesting.
Cars,
Interesting.
planes,
I didn't know that.
yachts,
I didn't know
baseball cards, you name it. We could exchange anything. Art was a big one. And so,
Wow.
but in 2017, when we did the new tax code, we figured that that was just too expensive to give up those tax benefits to Treasury, right, for collection. So what we did is we wanted to lower the taxable income rate, especially for small business owners, individuals. And we did that, right? We took it down to 21% for C corporations. That was a big benefit. And then for any other corporation, we gave them the 199, which is basically take 25% of your net profits and reduce the taxes from that. So that's what we accomplished. We also lowered the tax rates for individuals. How did we do that? You know, it's always in the magic, right? But part of it was, okay, you can't exchange horses, art, you name it, right? Any kind of goods, right? Gold, things of that nature. So we did keep it in real estate. Why? Because we think that was the most important investment where that benefit still has a great impact to our country, right? Because we need, we need affordable housing. We need a lot of real estate in our country, right? We don't have enough right now. So anyway, though, so we kept the benefit. So thank goodness we did that. And that's good. So, right, you have that $7 million building. You have a $14 million building now. So you have at least $7 million in basically what we would say gains, but profit. And we're going to pay taxes on that. And that's going to be a lot, right? And so that's going to be 20, 25% of that profit. It's going to go to the government. But you're going to 1031, you're going to go to a different property. Maybe you're going to go up in an asset class. And now that profit that's going 30% to the government, you're keeping to put into that investment and grow, right? So a lot of people, that's the great thing about real estate. We can accelerate the write-offs, right? We can 1031, we can go into trust. We can do a lot of different things to maintain that capital. Capital is so important to grow our wealth, right? Because it's exponential.
What's interesting is one of my, and as we're talking through this, right, I finally put all the pieces together for me, right? One of the things that bothered me about the 1031 is this. For that $7 million business, let's say I put $1.5 million of my own capital, right? When it comes sales time, I would love to get that $1.5 million back and return to me to then reinvest elsewhere, right? But that's not the way the 1031 works, right? I have to take my original everything that comes at the sale of that now $14 million asset has to go into either an equal or greater value property. Right?
Yeah, right. Unless you want to pay the taxes.
Right. And so I can't take my $1.5 million back, even though it's a return of principal. I have to roll that forward with it.
Yeah, or you can borrow. You can borrow against the new asset, right?
To get the 1.5 million and then use the debt. The interest payments become a business expense, right? So I'm really getting my money back for free and I get to utilize it. What I didn't realize, and because it is, I always wanted that money back, but as we're talking about the accelerated depreciation, is I received so much indirect cash in my pocket from the accelerated depreciation. So let's say I put 1.5 million as a down payment into that $7 million property, and I got a $4 million cost segregation.
Benefit, yeah.
That's dropping right down to my bottom line. So that $1.5 million in taxable income that I would have had goes away.
The depreciation gave you your cash.
Exactly.
To put the down payment down.
And in the future years and the future years and the future years. So it's kind of like the rich man, poor man thinking, right? The poor man thinking is, well, I want my capital back, right? But the reality is that I got my capital back over the life of the asset, and I got the tax deductions, and I got the appreciation, right? So income that I would have paid taxes on over the years of holding that asset, I actually got that capital back, even though, the dollar that goes out the door is easier to track than the dollar that never leaves the door, right? And I think for me, that was my mindset, right? And after our conversation today, it's like, light bulb, right? Because the dollar never went out the door in the first place, so I still had that dollar to spend, reinvest, and use it in other places.
It's
Makes
really
sense?
critical what you just said, right? Because you're basically cash neutral, right?
Yes.
You put $1 million down, but you saved $1 million plus in tax payments, right?
Right.
So again, going through the real estate analysis, you traded a tax liability for an appreciating asset, all done under our tax code.
Yeah.
I always say this, Will, if you want to have wealth in this country, you have to invest in assets that give you a tax benefit and own the assets, right? Because I think what you're saying is I can own these properties and I can get the tax benefit. So now I'm cash neutral because basically whatever I gave to the bank, I got right back in a tax benefit. And now I'm getting the rents and now I'm getting the appreciation. So it works great. And now the property went from 7 to 14 million. Now I just made $7 million and that's tremendous. Or you can be the person, the business owner that rents from other people. You don't get the tax benefit. You don't get the appreciation. You're spending the same amount, right? But you're paying it in rent without the tax benefits or the appreciation. So owning the asset, all the difference in taking that tax benefit and appreciation and rents, like with your dividends, like that's big. And I always say this, Will, that this is why I'm not in the stock market as much as most people because I feel like I'm giving them my cash and they're going to go spend it and get the tax benefits and whatever. And that doesn't come back to the investor, right? But, and that's just a different mindset. But I think that's how Robert thinks. I think that's how Greg does. I think it's a little bit different, but you're sharing that today. And I think that's great.
One of our mutual friends, I won't say who, he's a gigantic real estate investor, one of your clients. We were talking about, did you see the stock market today? Right. And he was like, what I love about real estate is I don't live and die by I'm up today, I'm down today. He was like, I have no idea if my real estate portfolio is worth $10 million less today than it was yesterday, or worth $20 million more today than it was yesterday. And so he's like, there's a certain sanity to having real estate because the tax benefits, because of the income generation, because of the other benefits for it. I'm not looking at my wealth in a binary, I'm up or I'm down.
Yeah.
Right? Because it's more of a long-term accumulation strategy than I'm trying to hit a double, I'm trying to hit a triple, I'm trying to hit a home run today.
Yeah. I always think of it this way, and I think that's a good, illustration. If I buy real estate, I spend $10 million on a real estate property, I'm going to get a $10 million write-off. Maybe a good part of it up front, but eventually I'm going to get all that write-off. If I buy a stock, and I think about the stock market, if I buy $10 million in stock, I'm not getting a $10 million write-off.
Right.
Right? Big difference.
Yeah.
And I'm not looking at the stock market every day. Now, I'm not saying the stock market's bad, but what you're saying is correct. Like, I get to write off that $10 million. And I don't have to watch the market every day. We know real estate is pretty, safe, especially if you buy in good places. And like it did okay through COVID. It did through, 9/11 and all these others, 2008 financial crisis.
Well, and also, history has shown us that whenever there's a significant dip in real estate, that is an amazing opportunity for people who previously weren't able to get real estate to get into real estate.
That's right.
Right. And so let me ask you a question, so let's say I bought a property. My cost segregation is based on the purchase of my property, right? What I bought it for.
That's right.
So if I bought that $7 million property for $3.5 million during COVID because the market was depressed, right? My cost segregation is really going against the $3.5 million, not the $7 million.
That's right.
On the flip side of that, if that was the case in COVID, I'd be buying two buildings for $7 million combined, right?
And still getting the same benefit
at the 3.5, and then I still get the same benefit and the appreciation and growth and building out my own individual portfolio.
Exactly.
When now is 1031 part of Section 179, or are they two separate?
Yeah, different codes, right?
Two different codes. Okay. So 179 applies to more vehicles, business equipment, et cetera.
Yeah, and it
applies but that's also an accelerated depreciation tactic.
Yeah, 179 is basically bonus depreciation on steroids, right, for assets that we buy under a certain, monetary value. And
what is it, 250? I think it's 250 now. I know it's not your area of expertise.
But you're right. It's that amount.
So up to 250,000. Like I know with vehicles, right? So if you bought the full-size Range Rover, right? It has to be over 6,000 pounds, right? It was originally created by George W. Bush for farm equipment, right? To help farmers be able to buy these giant combines that were, vast investments of capital, but it took them so long to get that money back. So if you had to buy a $1 million, crop machine, right, you could at least get a $1 million deduction in the year that you bought it and put it in service, right? I mean,
that's right.
That's the rationale.
Yeah, and now it applies to every vehicle over 6,000 pounds, right?
Right.
Yeah.
Right. So it's funny because if you look at like the cost of a vehicle, it doesn't matter that a vehicle loses 30% of its value when you drive off the lot because you're getting 100% bonus depreciation on that vehicle, right? So again, same example, I buy a $150,000 vehicle that's over 6,000 pounds. I get a $150,000 tax deduction in year one through Section 179.
Yeah.
If the vehicle loses 30% when I drive it off the lot, I'm negative 45,000 if I was going to sell that vehicle, right? I'd only get 145,000 for it.
Sure.
But if my tax rate is what's the tax rate? 30% for the highest income?
Oh, well, federal, and then we have state, and then we have local, right? So it could be at 50% for most Americans.
Is how much?
50.
50. Okay. So if I was going to sell that vehicle for the 100,000, I'd have a $50,000, right? If I bought it in cash, right?
Yeah.
So I'd have $100,000 in income that I'd take in. So I'd have $50,000, but I got a $150,000 tax deduction.
Right.
Right. So it's kind of the same example that I was saying earlier about, getting your cash out of a real estate investment in a 1031. So again, it goes back to like not thinking binary of I bought a $150,000 asset. It's only worth 105,000. Now I'm going to sell it. I lost 45,000. Well, no, you didn't, because you got $150,000 worth of deductibility on your taxes, which means you paid that amount less times your tax rate.
Yeah. Yeah. I tell people in December, okay, you need a new car, right? You owe $50,000 in taxes. Well, you can put that down on a Range Rover. I don't know what Range Rovers cost, but maybe it's double that. I'm not quite sure. And get the tax write-off. Mm-hmm. So you could have paid the tax to the IRS, or you can have a Range Rover. So you're in the same place.
Yeah. Well, so you bring up a really good point. We'll wrap it up here for this segment. But I think, I'm going to ask you your opinion as, the tax guru. What time of the year should people be meeting with their accountant to plan and make sure that they are prepared for their potential tax liability at year end?
You know, I say that you got to do it certainly by summer for that year, but maybe no later than the beginning of the fourth quarter, right? Because everything you can do to reduce taxes legally through all these different investment options, it takes time, right? Maybe you have to find that property. Well,
Right.
are you going to close in 30 days? But people start to think about it maybe
Right.
that week before New Year's Eve, right? But you can't buy it after January 1st and get the
Right.
tax benefit, you know, or
Right,
the car,
right,
same thing, right?
yeah.
So, and it takes
Yeah.
time to get financing in place, and
Yeah.
you know, whether it's a car, whether it's a jet, right, or a real
Real
estate
estate,
thing,
yeah.
same things, equipment. So
Yeah.
don't leave it to the end.
Yeah.
Like I think that people make, but don't. The worst thing is not even tax planning.
Right.
So if you have an accountant that doesn't do tax planning with you, eliminate them.
Yeah.
Right. Like they have to be proactive. They have to be.
Yeah. This is where you stand. This is what we're looking at.
I always
Let's
recommend
look at
people
this.
do it quarterly because you have quarterly tax payments.
Yeah.
As a business owner, so let's look at how we can lower the quarterly tax payments every quarter. So maybe the month before the quarter. That's what I would do. Listen, an accountant can be, you know, your best friend or your worst friend. If they're just taking your records, we're not doing tax planning. And at the end, there's like, oh, I did everything I did a little man, and here's your bill.
Yeah. Here's what you owe.
Here's
Right.
what you owe. That's compliance.
Right.
That's
Right.
not tax planning.
Right.
That's not tax optimization. That's not creating real wealth.
Yeah.
So I would get rid of that guy and find someone that's going to meet with you. And I would also say to people watching that don't leave it to the accountant. Be proactive. Like with health, do it with wealth. Like be proactive. Get an accountant. Tell them, hey, listen, I went into ChatGPT. I was trying to find some grants. I was trying to find some tax investments. I was trying to find some ways to lower my taxes. Here's what I came up with. Can we meet and go over this? I think that's important.
Awesome. Well, Julio, great having you.
Thanks for having me.
If people want to get in touch with you and find out more about cost segregation for a property they own, how should they do it?
Yeah, text ETS, ETS to 26786. And I'm on, social media at Tax Reform Expert, where I put up tips every day on how to find grants, how to look at different tax incentives, and ultimately how to optimize in both ways. If we're lowering our taxes, we're keeping more capital. If we apply for grants, we're having more capital, right? Both things we should be doing every day.
Awesome. Well, this is this episode of The Source, Rule Breakers, Lawmakers, and Influencers with my guest, Julio Gonzalez, CEO of Engineered Tax Services. Thanks for coming on today, Julio. We'll see you next time.
Yeah, thanks for having me.